Hello, good afternoon. This is for Equity Capital Funding Group. I'm Dan Fredenberg. I'm joined with my colleagues Chase Murphy and Joe Cook. Joe, how are you doing today?
I'm great. Thank you, Dan.
Excellent. And Chase, how about you?
I can't complain, Dan.
Excellent,
Thanks for
excellent.
having me.
And the reason why we're recording today, we just had a little head together meeting about the fact that the Fed has cut rates by 0.5%. It is September 18th, 2024. And I guess, Chase, well, I'll ping it over to you first of all. The inspiration for this, you've been talking to plenty of different people involved in DETA trust investments, different potential investors in the debt fund that we have put together here. What are some of the questions that are coming out as far as climate, and what's the overall level of knowledge as far as what are your thoughts and what have you been running into?
Well, I think across the spectrum, we're seeing all sorts of different reactions to what happened today. From what does that even mean to why should I care? At least as far as the private markets versus the public markets, I think there's a big confusion there as to what this means for private markets, and I think we'll see what happens. But I'm sorry, guys, I suck right now.
No, man,
Well,
that's just absolutely fantastic. And that's why we rely on Joe. The fact is that I
Thank you.
need to have somebody in my organization who's got the experience. I have a little bit of gray in my beard, but I don't have 40 years of experience in this industry. Joe, like you're here as the expert. What exactly, in terms of cause and effect, what does it mean when a rate is cut in real estate? And framing it, we are lending out people's capital to get better returns than you get from treasuries or a money market or something like that. So Joe, take it away.
well, I like, even though Chase stalled out, I like the way he prompts his thinking, because it really has to do with our investors' mindset. As a private debt fund, no matter what the market is, we get a higher spread. So in the past, some of our other stuff, it says we probably get 5 or 6% over the 10-year treasuries. So in the case of today, with interest rates going down, do the treasuries move? Well, probably not. They probably didn't move much. This is a really short-term thing. So the bottom line for our investors is they're not really affected. Our rates are going to stay relatively the same. Our liquidity is going to stay relatively the same. Our safety or our security is the same. And there's not a big effect. So then what is the effect? Well, the effect is that our clients, who are our borrowers on the other side, they're seeing all this anticipation of rates going down, and so their properties should be worth more money, and they should sell them faster. So that might even increase our liquidity.
I love it. I love it. And I think that you're starting to address the main thing that I think is on people's minds, which is will investors still sleep well at night, knowing that this interest rate is cut? Like, does that mean they're moving goalposts? It's not going to be as good. What do you think people are feeling in the market right now?
Well, that's the whole reason. I think most people are anxious. They've been anxious for this rate cut. I'm not talking about our clients, but I'm talking about most of the marketplace is anxious. I think the stock market has been anxious. The political climate has been anxious. People are anxious. We want to see that inflation's in control and the feds are down. Our clients and our investment committee is not anxious. We do sleep well at night. And the reason that we sleep well at night is the fundamental basic philosophy. And that is, don't get all anxious over over short-term adjustments in rates. Know that your investment philosophy allows longer term adjustments, 12, 18, 24-month adjustments, that you have enough liquidity that you can get out if you don't like how the rates change over those longer periods of time. But today and tomorrow, nothing's changed. It's the same as a week ago, It's going to be same in 2 weeks.
I think it really speaks to the evergreen nature of this business model and how it's not just chasing the most recent fad or whatever, fear of missing out that's going on around there. It really, if you don't have a plan for when interest rates go up and you don't have a plan for when interest rates go down, then that's kind of telling that you don't have a very effective business model. Does that seem fair to say?
That would be, I think that's fair to say. And it's exactly why we put this business model together. We said we want higher than absolute safe rates, but still say relatively secure. We want to use real estate, and we want it to be really, really stable. So yeah, it's the sleep test. If I sleep well at night, which we do.
Yeah, absolutely. That makes lots of sense. And lower rates, there's no question. It means that there's going to be more activity. There's going to be more deals going on because the weight of the loan is not going to be as heavy as before. But I want to get into a few more specifics without getting too far into the weeds about why companies come to us to borrow. And I think a lot of that has to do with the fact that we really understand real estate, whereas like a local credit union or a local bank, I think that they keep things at arm's length and they have more issues to attend to. Do you want to shed some light on what's so appealing about borrowers coming to somebody like ECFG as opposed to a local credit union?
Well, I really enjoyed that part of our discussion before we came on camera. I mean, the old days, people used to say, Joe, you're just a loan shark. Well, in the old days, it might have been, but the markets have really changed over the last 20 years, where private lending has become a bigger and bigger and bigger part of the marketplace, whether you call it hard money lending or asset-based lending or private lending. And it's become a bigger part of the marketplace for a couple of reasons. Not only do we understand the niche of the business that we're in? In our case, it's small commercial and residential properties, less than $2 million loans, less than 2 years, usually some kind of repositioning kind of thing. We understand that really clearly that we're after professional borrowers in that space. We don't have all the paperwork that the banks do. I mean, the banks have to follow all kinds of regulations to make the loan. So the borrower comes to us, and it's a lot easier. We've honed it down where we try to step between be an equity player and just being a bank, and we've made it easy for our borrowers to borrow the money, and they're going to pay us a higher rate for that, and they make more money because they're not paying an equity person, and they get their deals done faster. It's really become that simple, and I've watched this now evolve over almost 30 years. It's pushing 30, I guess, in the whole hard money arena. In the old days, I probably couldn't get, when I was the borrower, I probably couldn't get that loan from that bank under any circumstance. Today, we get borrowers who just want the speed and the ease, and they pay us a higher rate for that speed and that ease.
So it's not a situation where we're like a lender of last resort. There are plenty of other perks to borrowing from an entity like ECFG then, right?
Well, yes, and in Maricopa County in particular, in Arizona, there's like 30 guys like us. So it's even a competitor in the street side of it.
All right. So that sounds fantastic for people who have some excess capital or a little part of their portfolio that they don't want to manage themselves. They don't want to be the collector. They don't want to go through the foreclosure process. But I guess to wrap things up, to give everybody back the rest of their day, my last question is, what questions should people be asking if there are any? If they're thinking about having part of their portfolio, maybe like they have a 401k, some sort of self-directed IRA, something like that. Are there any questions you think people should be asking that we didn't really address here, Joe?
Well, that's supposed to be a softball, but I'm stuck. I truly don't understand why people don't do more investing in deeds of trust. And if they're not going to do it on their own, the question they should ask is, who do I trust to do it? And we've done enough transactions over enough years and gotten our head handed to us a time or two where we think they should trust us, and just look at the documentation. If you're getting around a 10% yield, and you've got a good general partner, you've probably asked enough questions.
All right, and back to Chase. If people are thinking about reaching out to us, there's a good chance that they're going to be talking to you first. Maybe they have some apprehensions, something like that. Do you want to say anything to people who might have a few more questions? They're not sure if they should schedule the appointment from ECFG.us.
Yes. Yeah. I mean, guys, we're willing to have conversations with, anyone who has any interest of deed and trust investing. I mean, we're not out here just looking to collect checks. We're trying to educate people and show them, what's possible when you go and look into this, asset type. And, we're willing to have conversations, whether they're educational or whatever. Please do reach out.
Thanks for watching. I just want to give you a couple of things to do the next step if that's what you're interested in. Right here, I have a QR code that you can scan, or you can go straight to capturetheopportunity.com to find out more about Fund 11 with ECFG and what we're basically talking about for accredited investors. But if you do have time on Thursday, that is the 19th of September 2024, you can check out capturetheopportunity.com/webinar. I should have that better prepared than I do. I apologize, but I wanted to get this content piece out with Joe and Chase and myself today since the rates were just cut. Thanks again for watching. Talk to you soon. Bye.
Does nothing but put more money in the pot.
Right.
If we talk about just the investor side, I mean, Shane talked about the sponsor side a little bit. I'll talk about the investor side. Okay, so you want the most money in terms of return with the least risk. All right, you want to do it yourself, you can go get 13 or 14%. You're going to do all the underwriting, it's not going to be passive.
If you bet, probably not.
I think I'd have to bet at least 2,500 before they fold.
And the pot is
4,000.
4,000. Yeah, I think you're right, but I'd rather just check.
Okay.
First position, you have the right of collection and the right of foreclosure or sheriff's sale, wherever you're at.